Hello students. Today in this video we are going to discuss the third chapter of accountancy, reconstitution of partnership firm, admission of a partner. In this video we'll discuss the topic revaluation of assets and reassessment of liabilities. Whenever a new partner is admitted to the firm, it is always desirable to ascertain whether the assets of the firm are shown in the books of accounts at their current values or not. In case the assets are overstated or understated, means the value of the assets has been shown more or it has been shown less, these are revalued. Similarly, a reassessment of the liabilities is also done so that these are brought in the books at their current values. So basically, the objective behind revaluation of assets and reassessment of liabilities is to show the values of assets and liabilities in the books of accounts at their current values, or you could say correct values. At times, there may also be some unrecorded assets and unrecorded liabilities of the firm. Means, it may happen some of the assets may not have been recorded in the books of accounts, and the same way some of the liabilities may not have been recorded in the books of the firm. So these also have to be brought in the books of the firm. If they are not recorded, then the same has to be considered in the books of accounts. For this purpose, the firm has to prepare the revaluation account. So this is the reason why we prepare revaluation account. The gain or loss on revaluation of each asset and liability is transferred to this account, and finally its balance is transferred to the capital account of old partners in their old profit sharing ratio. So whatever gain or whatever loss that will be there on the revaluation of each asset and liabilities, that will be transferred to revaluation account, and finally its balance will be transferred to partners capital account in their old profit sharing ratio. Means when we will prepare our revaluation account, the gain in the value of asset or the loss in the value of asset, gain in the value of liabilities or loss in the value of liabilities will be shown in your revaluation account, and finally we'll total the debit and the credit side of revaluation account, and if the credit side of your revaluation account will be more than the total of your debit side of revaluation account, then it's called gain at the time of revaluation, and the same will be transferred to the partners capital account in their old profit sharing ratio, or you could say old partners in their old profit sharing ratio. And if the total of debit side of revaluation account comes more than the total of the credit side of the revaluation account, then it's a loss at the time of revaluation. The same will also be transferred to the debit side of partners capital account, or you could say the old partners capital account in their old profit sharing ratio. In other words, you can say the revaluation account is credited with the increase in the value of each asset and decrease in its liabilities because it's a gain, and is debited with the decrease in the value of assets and increase in the its liabilities is debited to the revaluation account because it's a loss. It means whenever there will be gain, then you will credit it in the books of in the account of revaluation, and if there will be a loss, you will debit the same to the revaluation account. Similarly, any unrecorded asset, if now they have to consider, will be credited to the revaluation account because now a gain, and if any unrecorded liability has to be recorded in the revaluation account, it's a loss, so it will be debited to the revaluation account. And as I've told you, if the revaluation account finally shows a credit balance, then it indicates net gain. How you will get the credit balance? if the credit sets total will be more than your debit sets total. And if there is a debit balance, means when your debit sets total is more than your credit sets total, then it indicates net loss. As I've told you, this net gain or net loss at the time of revaluation will be transferred to the old partners capital account in their old profit sharing ratio. So this is very important, that it will be transferred to the old partners capital account in their old profit sharing ratio. It means the profit, or you could say the gain or loss of revaluation will not be shown in the books of new partners capital. It will be just shown in the books of old partners in their old profit sharing ratio. So this is very important. Now, while preparing your revaluation account, the journal entries that you will pass for revaluation of assets and reassessment of liabilities. For increase in the value of an asset, your entry will be assets account debit to revaluation account. As there is an increase in the value of asset, and as we know, as per the rule, whenever there is increase in the value of asset, we debit it, and the same increase in the value of asset will be transferred to revaluation account, and we will credit revaluation account because it's a gain. As per the rule, credit all income and gains. That's why for increase in the value of asset, your entry is assets account debit to revaluation account. Second, for reduction in the value of an asset, whenever there will be decrease in the value of an asset, it's a loss for the business. So we will debit revaluation account because it's a loss. As per the rule, debit all expenses and losses to assets account, and as per the rule, whenever there will be decrease in the value of asset, we credit it. That's why your entry for the reduction in the value of asset is revaluation account debit to assets account. Third, for appreciation in the amount of a liability, means whenever there will be increase in the value of or the amount of liabilities. So whenever there will be increase, it means a loss for the business, and as per the rule, debit all expenses and losses. So we'll debit revaluation account to liability account, and as we know, whenever there is increase in the value of liability, we credit it. So revaluation account debit to liability account. Fourth, for reduction in the amount of liability. So whenever there will be reduction in the amount of liability, it will be a gain for the business because we have to pay less to the outsider. So as per the rule, you are having gain and there is increase in the value of liability, and as per the rule, whenever there is increase in the liability, we debit it. Whenever there is decrease in the value of liability, we debit it. That's why your entry is liability account debit to revaluation account. To revaluation account, why? Because there is a gain, and as per the rule, credit all income and gains. That's why for reduction in the amount of liability, your entry will be liability account debit to revaluation account. Fifth, for an unrecorded assets. So whenever there will be an unrecorded assets, and now it has to be shown in the books of accounts, clear? Your entry will be cash account debit to revaluation account. It means this entry will be done when any unrecorded asset will be sold and will fetch some money to you, and whenever any unrecorded asset will be sold and it will fetch money to the business, so cash will come in. Your entry will be cash account debit, and this cash is going to increase your gain. That's why to revaluation account. So if any unrecorded asset will be sold, clear, then your entry will be cash account debit to revaluation account. Sixth, for an unrecorded liability, if any unrecorded liability is being paid now or has to be paid, then it will be shown in the books of accounts as you have to pay an unrecorded liability. It's a loss for the business because till time you don't have to pay that, but now you have to pay it. So your entry will be revaluation account debit, as per the rule, debit all expenses and losses to cash account, because the cash will go out as per the rule. Cash is a real account, credit what goes out. So your entry will be for an unrecorded liability. If that unrecorded liability has to be paid, your entry will be revaluation account debit to cash account. Seventh, for transfer of gain on revaluation if credit balance. Now, for transfer of gain on revaluation if credit balance, it means after transferring all the entries regarding debit and credit of revaluation account, if the total of your credit side exceeds the total of your debit side of revaluation account, then the same will be transferred, or the balance of the same will be transferred to the old partners capital account in their old profit sharing ratio. So whenever the total of the credit side, whenever the total of the credit side of the revaluation account is more than the total of the debit side of the revaluation account, then it's a gain at the time of revaluation, and the same will be transferred to the old partners in their old profit sharing ratio. The entry for the same will be revaluation account debit, because it's a gain, that's why we'll debit it, revaluation account debit to old partners capital account, because the same gain has to be credited to old partners in their old profit sharing ratio. So this profit will be distributed individually to the old partners in their old profit sharing ratio. 8. For transferring loss on revaluation. If at the time of revaluation of assets there is loss, means when the total of the debit side of revaluation account is more than the total of the credit side of revaluation account, then it will show loss on revaluation. So the entry for the same will be, and this loss is going to be debited to old partners in their old profit sharing ratio. So the entry for the same will be old partners capital account debit individually to revaluation account, and this will be done in your old profit sharing ratio. Now whenever you are preparing a revaluation account, the revaluation account will be debited or credited with the actual increase or decrease in the value of assets and liabilities. Like for example, till time you are showing your machine at rupees 1 lakh. Now the same machine has to be shown in the books of account at 1,20,000 now. So in revaluation account we are going to just show machine by 20,000, because there is increase in the value of machine by 20,000. So in revaluation account we are going to show just the actual increase or decrease in the value of assets and liabilities. Now we can understand it with the help of this illustration. Following in balance sheet of A and B who share profit in the ratio of 3:2. Should be following is balance sheet of A and B as on 1st April 2015. You have been given with liability side and assets. And liabilities, you have sundry creditors 20,000, capital A 30,000, B 20,000, total 50,000. Assets, cash in hand 3,000, debtors 12,000, stock 15,000, furniture 10,000, plant and machinery 30,000, and the total is 70,000. On that date, C is admitted into the partnership firm on the following terms. C is to bring in rupees 15,000 as capital and rupees 5,000 as premium for goodwill for 1/6 share. So here C is bringing 15,000 as capital and 5,000 for the premium of goodwill. As we have already studied in previous video, that whenever a new partner brings his share of capital and his share of goodwill, then cash will come in. Clear? So your entry will be a cash or bank. So your entry will be cash account debit or bank account debit. Clear? 15,000 and 5,000 means 20,000 to C's capital account. And as C is bringing 15,000, so you will do 15,000. 2 premium for goodwill account. Clear? 2 premium for goodwill account, as he is bringing 5,000 as share of premium. So your entry will be bank account debit to C's capital account to premium for goodwill account. Bank account debit will be by 20,000 to C's capital account 15,000 to goodwill account 5,000, or to premium for goodwill account 5,000 rupees. So this is the entry that you are going to make for your first transaction. Now second, the value of stock is reduced by 10%. Here the revaluation is now taking place. The value of stock is reduced by 10%. Now what you will do, stock has been given as 15,000 and the value of stock is reduced by 10%. So what you will do, you have to find the value that is reduced. So how you are going to calculate? Stock is of 15,000. 15,000 into 10 by 100. So it means the value is decreasing by 1,500. So you have to show the actual increase or decrease in the value of assets and liabilities in the revaluation account. So here the value of stock is reducing by 10% and it's coming 1,500. So for this 1,500 you will do the entry. And as I've told you, whenever there is decrease in the value of asset, it's a loss for the business. Clear? So what you will do, you will debit it to the revaluation account. So the entry for the same will be revaluation account debit 1,500 to stock account 1,500, because we are going to show the actual increase or decrease. So that is 1,500. Then you have been given with, while plant and machinery is appreciated by 10%. Now plant and machinery is of 30,000 and it is appreciated by 10%. Appreciated means it's going to increase by 10%. So when it will increase, it's going to be a gain for the business. And as we have already studied that whenever there will be gain, it will be credited. Now first we have to calculate the value. Plant and machinery is appreciated by 10%. The value of plant and machinery is 30,000 and it has been appreciated by 10%. So 10 by 100. So it's coming 3,000 rupees. Now this 3,000 is a gain for the business because the value of asset is increasing. And as per the rule, whenever there is increase in the value of, or whenever there is gain, we'll credit it, because credit all income and gains. So your entry will be plant and machinery account debit to revaluation account, and the value that will be shown will be 3000, because we are going to show the actual increase or decrease. So your entry is clear. Your entry is plant and machinery account debit to revaluation account. Then the next is furniture is revalued at 9000. Now you have been given furniture is revalued at 9000, means now the current value that has to be shown in the books of accounts of furniture is 9000, and in the old balance sheet it has been shown at 10,000. So means from 10,000 now the asset has to be shown, or the furniture has to be shown at 9,000. So from 10 to 9 it will be decrease in the value of asset, and it will be of 1,000 rupees. How? Because in the old books we are showing it at 10,000. Now we have to show it at 9,000. So there will be decrease. Clear? So there will be decrease in the value of furniture by 1,000 rupees. As this is the decrease in the value of asset, it's a loss, and as per the rule, debit all losses and okay. So we'll debit it. So the entry for the same will be revaluation account debit to furniture account, and the amount that we are going to write is 1,000. Then the fourth one, a provision for doubtful debts is to be created on sundry debtors at the rate of 5%, and rupees 200 is to be provided for an electricity bill. Now before transaction, a provision for doubtful debts is to be created on sundry debtors. Now till time you don't have any provision for debtors, now you have to create a provision for your doubtful debts. Now how you are going to calculate it? You have been given with the value of debtors as 12,000. On this amount we are going to create this provision of 5%. So the provision that will come, provision is equals to, as it has been said, it's to be 5% of debtors. So 5 upon 100. So it's coming 600 rupees. So the provision that we have to create, clear, it's going to increase our liability, because provision are being shown on the liabilities side. So whenever there is increase in the values of liabilities, clear, it's a loss, and loss is to be debited. So the entry for the same will be revaluation account debit to provision for doubtful debts, or to debtors even you can write, and the amount that you are going to write is 600 rupees, because whenever there will be increase in the provisions, it's a loss. Clear? So we'll debit it to the revaluation account, and the entry for the same will be revaluation account debit to debtors account, and the amount that you are going to write is 600 rupees. Then you have been asked rupees 200 is to be provided for an electricity bill, means till time this transaction is unrecorded. Now you have to pay 200 rupees for electricity bill. Clear? So rupees 200 is to be provided for an electricity bill. So it's going to increase your expense. So you have to debit it. What you have to do? You have to debit it. Clear? And if the same you are paying, now your transaction is rupees 200 is to be provided for an electricity bill. It means it's an unrecorded liability or expense. Now you have to record it. So it's a loss for the business. So your entry will be revaluation account debit to outstanding electricity bill, and the amount that you are going to write is 200 rupees. Fifth, investment worth rupees 1000 not mentioned in the balance sheet is to be taken into account. Now this is your unrecorded asset. Clear? Investment worth rupees 1000 not mentioned in the balance sheet is to be taken into account now. It means what? It is your unrecorded investment. Now it has to be recorded. So now when you will record the same in the books of account, it's going to increase your asset. So it's a gain for the business. So as per the rule, whenever there is gain, you credit it. So your entry will be investment account debit to revaluation account, and the amount that you are going to write is 1000 rupees. Sixth, a creditor of rupees 100 is not likely to claim his money and is to be written off. Means there is a creditor of rupees 100 and this individual is not likely to claim his money now. So it will be a gain for the business because 100 rupees less has to be paid now. So whenever there is gain, you credit it. So your entry will be creditors account debit 100 to revaluation account 100. So this is how you are going to record the transaction in the books of A and B and C. Now finally what we will do, like for example, if you will prepare the revaluation for the same transactions as per the entries. Clear? Now as there is increase in the value of plant and machinery, that to be shown on the credit side. So you have written plant and machinery 3000. Now investment has to be recorded. There is increase in the value of investment, so investment 1000. Sundry creditors, they are not likely to be raised now, so sundry creditors 100. The value of stock has been decreased by 1500. The value of furniture has been decreased by 1000. Doubtful provision for doubtful debt has to be created, it's coming 600, and outstanding electricity bill is there 200. So these are the values that are to be shown on credit side and debit side. Now to find your gain or loss at the time of revaluation, what you have to do, after transferring all credit sides and after transferring all your debits, you will total your debit side. Then like in this case, on the credit side you have plant 3000, investment 1000, and sundry creditors 100 rupees, and the total is coming 4100. And the debit side is stock 1500, furniture 1000, provision for doubtful debt 600, and outstanding electricity bill is 200. So what you will do, you will total the credit side and you will total till this your debit side. Clear? From the total of your credit side, you will subtract your total of debit side. Means credit side total is 4100 minus the total of your debit side, means 1500 plus 1000 plus 600 plus 200. So these are the amounts of your debit side. So from the total of your credit side, you will decrease the value of the total of debit side, and the left balance, if the credit side exceeds then your debit side's total, then it will be a profit on revaluation. So when we will subtract it, we are getting it 0, 0, 8. It's coming 800 rupees. So this 800 rupees is the profit on revaluation, and as I've told you, this profit of revaluation has to be transferred or credited to old partners in their old profit sharing ratio. So this 800 rupees you are going to transfer to old partners in their old profit sharing ratio. Clear? Now, as it has been given in the question, the old profit sharing ratio between A and B is 3:2. So, this 800 rupees, or you could say the profit on revaluation of 800 rupees, will be distributed among A and B in their old profit sharing ratio. So, A's share in the gain or in the profit on revaluation will be 800 into 3/5. Clear? So, you will calculate it this way, and it's coming 480. Clear? For B, it will be 800 into 2/5. So, it's coming 320. So, this is how you will calculate the share of A and B at the time of gain or loss on revaluation, and it will be distributed among old partners in their old ratio, only to the old partners in their old ratio. Now, as it will be transferred to the debit side. Clear? So, this is how you are going to revalue your assets and reassessment of your liabilities. Now, if you will be asked to transfer the same and the same in your partner's capital account, clear, the same can be done. All the transaction will be transferred, and this revaluation is also transferred, or the profit or loss on the revaluation will be transferred to the partner's capital account. So, this is how you revalued your assets and to the reassessment of your liabilities. Thank you.